Folks, today I want to talk about three indicators, very, very stable indicators that are pointing to an economic recovery. Now, we're going to have it's not going to be a smooth ride. There's going to be bumps in the road, but at least things are moving in the right direction. So I want to review with you a few things that are really making me focus on this. So the first one is retail sales. Now remember, retail sales makes up 2/3 of our economy. So if retail sales is moving up, that's very positive. Now, as a side note, just this morning, today, Target came out and said that their online retail sales, their online platform, is up 197%. Yesterday, Walmart said that their online platform is up 97%. 97%. Store sales are up only 10%. So people are starting to spend money. Consumer discretionary sector is the number one in the stock market right now out of the 10 major sectors. That's consumers spending money. That's contributing very, very well. But now let's look at some figures. So this is retail sales. Advanced estimates for U.S. retail sales and food services for July 2020 were at $536 billion, an increase of 1.2%. from previous month, but get this, a 2.7% rise from July of 2019. So we are spending more money now than we were a year ago. That is huge. We were getting really caught up in this brick and mortar model, and it doesn't seem like it's coming back nearly as fast. But what consumers are doing, they can't keep their money in their wallet. They are spending their money. They're just doing it via online, which is one of the reasons why we saw the freight shippers like FedEx and UPS rise in the past couple of weeks. So retail sales are hot right now. I mean hot, and that's huge. Let's talk about industrial production. Now, it's slower. It's not coming back as fast, and it's not expected to. But get this. Total industrial production rose 3% in July after increasing 5.7% in June. Even so, the index in July was 8.4% below its pre-pandemic February levels. Now, manufacturing output continues to improve in July, rising 3.4%. So it is a little bumpy, but it is coming back. So we're down and we're recovering. But in terms of industrial production, at least we're not going to end up with a 30% annualized loss like the GDP estimate suggested. So that is huge. We are seeing some rise in industrial production, and that's huge. Now, here's another major indicator. Housing starts. Housing starts usually, typically, 99% of the times, do not begin spiking in a terrible economy. Interest rates are low. Fed said they're not going to be raising rates for a while. A lot of people are looking to refinance their home. And what they're doing is, a lot of people, the mentality is, I don't care about how much I owe. I care about my payments, quality of life. That's the American way. I hate to say it, but it's true. So what they're doing is, if they can get a loan and take some money out of their house, they're spending that money. They're buying that. They're using it for home improvements, which is great. They're using it for discretionary spending, which is great. And a lot of them are using that money to buy another home. So what they'll do is they'll sell their home and they'll buy another home. They're moving to different states. Some states have a bigger lockdowns. There's a huge exodus coming out from California right now with their super rich tax that was just announced. Don't get me started with that. I'm so glad I left over 2 years ago. And I'm in Florida now with no state taxes. So again, don't get me started with that. But look at housing starts. The estimates were 1.169 million, 1.32 million. We were almost at 1.5 million. That is a hot housing market. And what happens when people buy homes? People buy cars. Do you know that the average person, after buying a home, ends up buying a car less than 2 years later? They end up improving their homes. How about pool equipment? How about furniture? So housing starts, retail sales, housing starts, industrial production, all these things are starting to heat up. And most importantly, and I saved the best for last. I told you we were going to give you 3 indicators that were pointing to recovery. I'm actually going to give you the 4th. Look at the S&P 500. Most importantly, well, not most importantly, it's making new highs for the first time since February. But most importantly, if you look at, and this is what I was talking about earlier today in my morning video, but this is something to be happy about. If you look at the cumulative S&P strength over the last several months, if you were to look at the strongest stocks, you would see nothing but technology and biotech or healthcare. Finally, we're starting to see FedEx. You know, all that increase in buying online, it has to get to your house somewhere, right? All those buying, all that increase in retail, people are using FedEx, UPS. They're using it to ship merchandise. We're now seeing retailers coming back, L Brands, PayPal. They're using something to pay. Hey, they're using PayPal to pay for their merchandise. Amazon, Fortune Brand, Best Buys. Where is Gap? Gap is even in here. And this is out of 500 stocks. We're talking like the top 20 stocks. So you are seeing an influx of capital that is broad-based in the S&P 500, which is what it's supposed to be. The S&P 500 has 10 major sectors. And if we see everything focused on technology and on healthcare, that's a very lopsided market. So we're starting to see a lot more other industries like basic materials, retail sales, industrial stocks, freight shipping, which is transports. We're seeing a much balanced overall market. And this is a lot healthier because if you have 2 sectors out of 10 moving everything higher, it's a very lopsided market, and that's not an even flow of capital, and it's not sustainable. So I'm actually anticipating some weakness starting to move into the tech sector, like hard tech, like cloud computer, chips, and more strength coming into broader stocks like consumer staples, consumer discretionary, transports, basic materials, utilities, and so on and so on. And we're finally seeing it with the S&P, finally, since February. Let's see the date that it happened here. February 19th. And today, as you can see, there's a little red mark next to it. Today is August 19th. So February 19th, August 19th. It took 6 months, but the S&P is an all-time high, and we have 3.5 or 4 indicators that are consistently showing more strength in the broader market. Keep your eye out for the energy sector. Keep your eye out for utilities because that's very defensive. But in terms of consumer discretionary, basic materials, and very, very broad stocks like housing stocks, freight shippers, they are hot right now, and I am seeing more upside in those stocks. So I hope these 3 indicators give you a little more confidence in the current economic cycle, and I hope that helps. Folks, many trading strategies out there, they don't work. Yes, they simply don't work. Yes, even some of the popular ones that are touted by financial pundits, even some of the biggest ones out there. I wouldn't recommend these strategies to a stranger, let alone to a trusted reader like yourself. It can be difficult to know how you should trade. That's why I've teamed up with Josh Martinez to reveal a system that could take advantage of the strategies that don't work. I'm going to repeat that right now. Take advantage of strategies that don't work. Think about it, giving you the potential to earn almost 1,000% on your money in just a few days. Now, we're going to fill you in on all the details, so click on the link below. Make sure you don't miss out. I'll talk to you soon. Really, don't miss out.